Welcome everyone. So in this video I will simply explain to you how we will go about the mutual fund initiative that I've talked about, and I will also give you some basic information about mutual funds and mutual fund investing. Now, even though, like I said, I won't be charging any fee for this, but that doesn't mean that I don't go about this in a professional manner. So that's the reason why I'm creating this video, so that you get the best possible idea about why mutual fund investing is important and what is the process of going about the same. So first, let's just look at some of the basic aspects. So this is basically about the mutual fund SIP industry. So you can see that from 16 to 2022, there has been a clear rise in the SIP investments, and the only dip was in 2020, which was obviously due to the COVID crash. But you can see the fall wasn't too much, it was very sort of insignificant. And the growth in SIPs has been at a rate of 24% annually, which is very, very significant despite this major crash, and despite the fact that for the last 1 year or slightly more, the markets have generally been trending downwards. There has still been a very significant rise in SIPs. So that tells you the confidence that investors now have in our stock market, and most importantly, the potential of Indian equity to fulfill goals, especially long term goals. So, this is a very important aspect, that more and more people are coming into mutual fund investing through the SIP method. So, this is actually the best way to achieve one's long term goals. Now, this is simply an example of how compounding creates wealth. So, I've assumed a rate of return of 8%. We put 100 rupees initially, and after a period of 40 years, that 100 becomes 420. This line shows the growth of that money when we use simple interest. So basically, if you're getting, for example, if you're investing 100 rupees and you get 10%, you get a return of 10 rupees, right? Next year also you'll get 10 rupees only, irrespective of what is the value of your portfolio. So that is basically simple interest. Compound interest is basically when you get return on the value of your portfolio. So if compound interest is used in this particular instance, that 100 turns into 2172. So you can see the massive difference between the two. Same rate of return, but you can see how wealth starts to significantly move up after a certain period of time. This is why the longer you stay in investing, the greater the wealth you create. So we have to let compounding come into play, which means that you need to start investing early, even if the amount is small, and you need to let it go on for a long period of time. Now, this is very important. It basically relates directly to mutual fund investing, and it's very important that you understand this. We can divide the types of goals that you can have for mutual fund investing into two: primary and secondary. Now, the primary goals are basically the most important goals that you can have. So, the first is wealth generation, where you simply want to generate wealth for the long term, right? The second is retirement planning, which is very, very important. So, if you're 20, 25, 30, 35, 40, even 50, you can always plan for a retirement. And the early you start, the better, even if it's just a few hundred rupees. But because you have 20, 30, 40 goals or 40 years ahead of you, the kind of corpus you can create, you cannot even imagine that right now. So everybody should use mutual funds to plan their retirement, because of the long time horizon that you have, and the kind of compounding that would come into play if you have that kind of a long term horizon. The next is income generation. So many people want to create a corpus through mutual funds, and then they want to start withdrawing it for their monthly expenses. So you can generate an income through this, through mutual fund investing. Now, your children's future, whether it's education or marriage, you can use mutual funds to fund those two things, and they're very important goals, and one should definitely look into both these goals, especially when the kids are very young. The fifth kind of major goal can be buying a house. Now there are some secondary goals also, meeting emergencies. So if you have some kind of a financial emergency, um, where the kind of funds that you already have are not enough, maybe the insurance that you've taken is not enough, maybe the person who's earning in the family suffers some problems and they're not able to work, anything of the sort, you can meet your emergencies through the corpus that you've created through mutual funds. And that is a secondary kind of a goal. So this is something that you don't plan for, but if in case something like that happens, you have something to depend upon other than the liquid cash that you have. The other secondary goal can be enhancing your lifestyle. So again, once you create a corpus, you can use that money to enhance your lifestyle or standard of living. And the next is tax savings. It's very common and it's very useful also. Through ELSS we can do this. So the tax saving aspect is also a very important aspect of mutual fund investing. Now, one of the important things that I'd like to point is there are over 15 funds that allow an SIP of just 100 rupees per month. So you can invest just 100 rupees every month, and that sort of gets you going in the investment world. So it's not that you have to invest 4,000-5,000. I mean, it obviously depends on how much you actually need in the future. But if you just want to sort of create wealth, or just want to have just create a corpus through the equity investing, you can start as low as 100 rupees per month. So that is one of the biggest advantages of mutual fund investing, and that is why everyone must do, because 100-200 rupees is absolutely nothing. Anybody can do it. So just staying out of mutual fund investing or SIP investing is not logical when you can start with just 100 rupees, right? So if you don't have any particular goals and just want to accumulate wealth, you just want to earn more on the money that you save, then you can start as low as 100 rupees, which is an incredible advantage that equity and SIP offers. Now, this is very, very important, inflation. And these are things that probably people won't tell you and you might not know exactly. So basically, if we keep aside the normal inflation that goes on in any country, we have two major inflation aspects. One is medical and the other is education. Now in India, medical inflation is expected to be around 8%, which would be usually about 3 to 4% more than the normal or targeted household inflation. So normal household inflation or normal inflation that is targeted is about 4 to 5% in India. So medical inflation is 3 to 4% more than that. Now, if you don't plan for these things, the expenses are most when it comes to the medical aspects in the old age. And if you suddenly need a lot of corpus back in your later part of your life, it's you will have a lot of expenditure to do, and if you haven't planned for that, it can impact your life in the old age, which you definitely don't want to happen, because you are in a part of your life when you want to be mentally peaceful. And being mentally peaceful in the latter part of your life depends a lot on how financially stable you are. So through SIP investing, you can cater to medical inflation, which is sort of it comes in the category of meeting emergencies. The next is education inflation, and this is supposed to be around 10%, which is nearly double of the normal inflation that you have. Now this is very important because everybody's children, they want to go to better colleges, some even want to study abroad, and it's so easy to just say that okay, we'll take a loan. But if you don't plan for education, it can lead to very significant liabilities, not only on you but on your children when they reach 20-22 years of age. So it's not appropriate to accumulate that kind of a loan at such an early age of life. Why? Because when you start earning, if you are putting obviously you have a significant amount of expenses from the income that you earn, but if the rest of the money that you have, it goes into paying a loan, you're not saving early on in your life and you're not investing early on in your life, which is the biggest drawback that you can have. Because if you don't do that, you will start investing late in your life, and then you will have to invest more to reach the same goal. So it's very simple. If, for example, you have a 1 crore corpus goal at the age of 50, now if you start at 20, and in comparison to that, if you start at 30, it's only logical that if you, to achieve the same corpus, you have to invest more when you're 30 than when you're 20. So the advantage of catering to education inflation through SIP investing is that if you don't need to take a loan when your child goes to a good university or has to spend tens of lakhs of rupees for the education, if you don't need a loan at that point in time, and you cover the expenses through the corpus that you've created through SIPs, the child can start to save from 20, 22, 24, 25 at a very early age. And that leads to, number one, a habit of investing early on. Number two, a very, very great, a very high potential for a great corpus in the next 20, 30 years. So the effect is massive. When you pay something to an EMI, please understand that every rupee you pay towards the interest is 1 rupee that does not go into growing your money. So that is why it's very important to cater for education inflation. Now let me just run you through the basic process of mutual fund investing. So the first step is collecting relevant information from the investor. The second is determining the goals and assessing how much investment is needed. And this is very important because people just put some amount, whatever they think they can, they just put into, SIPs, 2,000, 5,000, 10,000, 15,000, whatever it is. But it's never done that way. You need to know what your goal is and how much do you need for that. And then you need to start investing according to that. The third step is selecting and investing in appropriate mutual funds. And the fourth is monitoring every few months. And if any action is needed, that action is taken. Let me just go slightly deeper into every single step. So the first is obviously basic information about the investor. And a great part of this is to get a fair idea of the willingness and the ability of the investor to take risk. And then the information is utilized to arrive at an appropriate level of risk that suits both the investor's mental and financial situation. So risk analysis is a very important part of this first step. And on the basis of that, investing has to be done. The second step, like I said, is the most important step, and it determines how one moves forward. So the types of goals are determined in this step, and how much funds would be required is also determined. Unless you do that, you actually don't know how much you should invest, what position you will reach after 10, 20, 30 years. So it's basically blind investing. You're just putting money into the markets without having any proper goals and knowing how much to invest. Once this is done, a reverse calculation is done to ascertain how much the investor needs to invest from now to reach the goal. So this is the second step. The third step is, based on the first two steps, we select the funds for investment. Now ideally, the amount of investment should be the amount that is actually needed to meet the goals. But many a times that's not going to be the case. So for example, you might actually need to invest 20,000 per month to meet a goal, but you don't have that much free cash. So you're able to invest only 10. So what we do is we start the investment, because there's no logic in, delaying the investment. It's, many times what people do is, if the amount needed is higher, they wait until they have that 20,000. For example, like I just said, if somebody needs to invest 20,000 every month to reach a goal and they have 10,000, what they'll do is they'll wait till they have 20,000 free cash. But they don't understand that the time that the time that is elapsed in that process, say after 3 years you are able to accumulate 20,000 free cash every month, the investment needed also goes up. So then it moves to, for example, 30,000. So you will never be able to do that. So it's very important that investment is started right then and there, and then with time the investment is increased. Now in this step, diversification of mutual funds is also ensured. So how many funds we need and how much to put in a certain fund is ensured in this step. The final step is obviously monitoring, and this can be done every 6 months. Even that is not needed if the market is fine and if there's no real change in the investors financial and social situation, right? So, and this is done, uh, it's not free, you don't need to do it frequently because you're investing in mutual funds, right? So it's not necessary to sort of look every month how much the mutual fund is gaining. Now turnover, which is basically changing the existing mutual funds, is kept to a minimum because mutual funds need time to grow. So unless absolutely needed, sorry, unless absolutely needed, a fund is not removed. And once the goal is achieved, the investor can start withdrawing their funds. Now, how to get started? This is basically about how I will go about my initiative and how I will help you to do this. There is only one prerequisite, which is a new Demat account at ICICI Direct. So this will be opened through a link that I provide. Now, there are two reasons for this. One is keeping separate the investment done for a specific goals gives clarity about the progress being made. So you know that you've put money in a separate account for a certain goal. So you know what progress is being made, and this reduces the element of decisions being taken purely on emotions. So when you have a separate account, you don't just buy and sell because you want to or because suddenly the market has dropped, so you sell. You don't take decisions on emotions, you take decisions practically. It makes a lot of difference when you have a separate account for these things. So in the past, I've helped some people create equity portfolios also, and what I told them is separate your trading account and your investing Demat account. Keep both separate. So what happens is when you have a separate account for investing, you look at those stocks in a different way. So you don't sell them unless something fundamental changes about the stock. You don't sell because they fall 10%. But if you're trading and a stock falls 10%, you should probably exit, right? So a lot of times what happens is when people have a single account for both these things, they sell their investments early if the stock falls or if the stock rises, but they keep their bad trades going on. So if a stock is you've taken for a trade and it falls 10-20%, you still keep it simply because you hope that it's going to come up, but you don't understand that it's a trade and you need to exit and put the money somewhere else. So similarly here, a separate account for a particular goal is very important because your entire outlook changes towards investing. And investment done under my supervision helps me in monitoring and suggesting relevant changes. So these are the only two reasons why this is one and the only prerequisite. If this suits you, you can move forward. If not, then it's absolutely no problem. But this is the only one prerequisite. And the process is such: open a Demat account at ICICI Direct. Why ICICI Direct? Because I have a brokerage with ICICI Direct. So it basically what I just said. It helps me monitor your investments, and I'll share simple questionnaires to help me understand you better. Because, like I said, just because I'm not taking a fee does not mean that I'm not going to do it professionally, even if I have to spend a lot of time on it. So, simple questionnaires that will help me understand you better. Then we'll identify your goals, and after that, based on the info, I'll create a detailed analysis for your portfolio. And after that, we make the investments in your account. So this is the basic process. Now, lastly, this is something that I wrote because I've seen so many people, I've talked to so many people in the last few years about investing. And a very common thing that they say is that they don't have money to invest. So probably they think that 200, 300, 500 rupees is nothing to invest. Now, just read this. Often people with limited means think equity is risky. On the contrary, for a family with limited scope of income growth, not investing in equity is risky. And the reason is simple. Such families need to expand their wealth to meet goals, and by avoiding an asset that offers the highest potential return, they are putting at risk their future. Do you understand this? It's not traditional knowledge or something that people often, they don't look at it from this perspective. But if you have limited means, if your income is limited, if there is no scope for extraordinary gains or growth in your income, from where do you create that extra return? You can only create that from your investments. Now you can put it in a bank at 5% or in a mutual fund at 10 to 25%. It's not risky, because what is the basic risk that you're taking in mutual funds? That maybe you expect a fund to give you 15%, but it gives 10%. It's still double what you're getting in the bank. So when you're not putting your cash that you have completely free in an asset that gives you the highest potential return, you're putting at risk your future, because there is no other means that you have that will grow your wealth at a compounded rate. So eventually you'll not be able to meet your goals, because you're putting in absolutely safe assets like gold and bank and whatnot. And some people just go into insurances, which is absolutely wrong. They invest in insurances. Insurance is not an investment tool; it's an insurance tool. So if somebody has millions of rupees, right? If they have multiple homes, if they have a lot of cash with them, if they have a lot of assets, they don't need equity. They can still put into equity, but they don't need it, because they already have so much with them that they can easily meet all their goals in the future, even if they're very expensive goals. But somebody, a middle class family or a lower middle class family, that does not have that kind of luxury, the only asset that they have which can actually grow their money at a very good rate is equity. And you can do it in a reasonably safe manner through SIP investing. So if you're not putting your money into this, you're actually putting your risk at future. You're not putting your money at risk, you're putting your future at risk. So that is why it does not matter how much you have. Like I said, there are over 15 funds that start at just 100 rupees a month. But it's important to get into this and have a long time horizon. The only two things required from a mental point of view is start. Amount does not matter if you are just looking to accumulate wealth, and start early so that you have a longer time horizon. So I hope this video gave you a lot of clarity, not just about what I'm trying to do, but how it is done. And you can, if you're interested, you can simply message me personally, and then we'll move forward in the process. Thank you.